last month said it expects to see lower sales volumes offsetting higher gross profits. So we'll see, as you said, this kicks off the earnings seasons, and we'll see a lot on Friday.
Stock is up by more than 7%. Isabel, thanks for that. The broader equity market right now, about 8 minutes into the session, positive by not even 1/10%. Really muted price action. Want to take it from autos to financials, looking ahead to big bank earnings kicking off on Friday with JP Morgan, Citi and Wells Fargo. 20's Tony Rodriguez sounding the alarm ahead of the results and writing this: "We believe financial sector earnings will be pressured, consistent with decreasing 2023 earnings growth estimates since the start of the year. Banks will be facing regulatory pressures on capital and liquidity, as well as increasing competition for customer deposits." Tony Rodriguez, I'm pleased to say, joins us right now. Tony, is the conclusion here ultimately, and welcome to the show as always, sir.
And we're also seeing that there's going to be pressure on the lending side, as there's going to be greater conservatism across, we think, the banking industry from the loan side. And of course, these rising rates, we know that has pressured their balance sheets. You see the unrealized losses that are on the balance sheets of all these companies. So we take that to mean that from an equity market perspective, we think it's going to be pretty challenging for the financial sector. When we look at the fixed income space, however, we do think that their balance sheet strength, while we're going to see some weakness clearly on asset quality, it is really at a very strong level, and we think will support financials kind of through the balance of this year, through the bottom of this economic cycle that we're expecting to hit towards the end of the year, early next year. So on the fixed income side, we think there are opportunities in financials, that earnings will be a headwind for financials across the board.
Tony, something you said, we expect to increase risk over the coming quarters as wider spreads offer better entry points. That's always the hope, Tony. It's always the hope. Are you actually going to get those wider spreads, and what do you think the catalyst is going to be for them?
So we think that the catalyst is going to be a greater appreciation for the economic weakness we're expecting to see in the fourth quarter and early next year. So our call is that this tightening in financial conditions, all of the Fed rate increases that we've seen, we're going to begin to see a slowdown in the consumer, and that is going to drive what we expect to be a relatively mild, short recession. But right now, we don't think that valuations necessarily fully reflect that. So we're not expecting a washout by any stretch, as you might see in a very hard landing, but we do think that you'll see some modestly better entry points as we move through the balance of the middle of the year here, given expected volatility to continue in the marketplace. And we think that weakness in the equity market will reverberate a bit into the fixed income space as well, leading to some wider spreads for risk assets.
Tony, out of interest, what kind of levels are you looking for?
Yeah, so Jonathan, if you look at, say, what the high in spreads were back in September, October, we think we can get back to that level for the investment grade marketplace. For the high yield market, we don't think we'll necessarily retrace all of that. So that puts you in a context of maybe 25 basis points on the investment grade market. In credit, when you look at kind of high yield leveraged loan space, you could see somewhere in the neighborhood of 75 to 100 basis points of widening. That will still lead to a very attractive total return outcome for investors, because starting yields here, if you look at below investment grade, we're talking 6.5 to 8.5 or 9% yields. So we think the market is pretty well positioned for mid-single to maybe slightly upper single-digit returns out of those below investment grade spaces, and we think that's an attractive return relative to equities and competing assets.
Tony, right now the Treasury market is priced for interest rate cuts. You're well aware of that. The equity market, some parts of it, have taken comfort from those interest rate cuts. Michael Harnett of Bank of America said investors are too optimistic on rate cuts, not pessimistic enough on recession. He said sell the last hike. Now, when you think about selling the last hike, Tony, you've got to work out what will be the last hike. Have we seen that already at the last meeting, or is the last hike still in our future?
So we think that the last hike is still in our future, and we think it'll come at the May meeting. From there, we do think that the Fed is going to be on hold, most likely for the balance of the year, even though we do think there's a possibility that by the end of the year, call it the December meeting, there may be the first cut. but otherwise it comes in the first quarter of 2024. So we think it's an on-hold Fed after this next 25 basis points for the balance of the year. And we think that the economic weakness that we're expecting is going to be a significant headwind when we look at the equity market in particular, and when we look at corporate earnings. But we do think that as we turn the corner to 24, you have a better outlook. And in fact, the data tells you that at the date of the last hike, forward-looking returns for the ag, for short treasuries, for example, all are positive. So the best entry point from a timing perspective in terms of total return is typically the date of the last hike. So we think that will be in May. And so we think that there'll be some better entry points, as I mentioned, from a risk asset perspective, but from a total return perspective and our view about underlying kind of high quality treasury rates, we do think we'll see lower yields at the end of the year than where we are today.
Tony, appreciate your perspective. Always do. Tony Rodriguez there of Nuveen on this equity market and on credit too, and on the Federal Reserve. 14 minutes into the session, equities just about positive by like that much on the S&P 500. The NASDAQ, the tech-heavy story, just a little bit softer this morning so far. As I keep repeating, back to the calendar. CPI tomorrow, Fed minutes, then through the week, some bank earnings too. Coming up next on this program, the US walking a fine line with China.
The U.S. is not seeking to decouple from China. We're not seeking to limit China's growth.
The United States and the Philippines kicking off its military drill after China concludes its own. More on that up next.
We occasionally or frequently have issues with different economic policies in China, and we will always defend U.S. economic interests as well. But we're not in any way trying to separate these two economies entirely. That's just neither practical nor in our interest.
Major economies walking a tightrope as U.S.-China tensions remain elevated. The U.S. and the Philippines kicking off one of their largest military exercises in more than 30 years. The Chinese Foreign Ministry issuing a response saying the two nations, quote, must not interfere in South China Sea disputes. This coming as the French government walks back President Macron's remarks calling on Europe to stay out of the conflict over Taiwan. Our team coverage starts right now with Bloomberg's Anne-Marie. Anne-Marie today, both here in D.C. This is nice. The team's back together. Maria, let's start with Macron's comments. What kind of walk back have we seen so far?
Well, we're about to find out because, in fact, he is giving a speech in about 30 minutes at The Hague when he will talk about the future of Europe. So he went on this trip. Obviously, a lot of the issues started not so much on the trip, but on the way back. So he took a couple journalists. But this is typical Macron. There's nothing here that's unusual. So he decides, I will talk to maybe 3 or 4 reporters. We do this interview, and then on the way back, we debrief the trip. Obviously, there was that political story, which was controversial. The comments on Taiwan obviously were controversial. The timing of it was very bad because we knew that China was doing all this maneuvering around. And then, of course, there was a quote check at the end of the article which said he made even more comments, but we could not print them because the Elysee, so the French palace, did not approve them. So now what we are seeing here, particularly in D.C., not so much in Europe, is French officials suggest a lot of this misinterpretation. People just don't get it when he speaks. This is also something we hear all the time. Like, the press just doesn't get it. He speaks in a way the reporters do not get it. But at one point, there's a very fair question. If nobody understands what you say, is it you or the press that is simply too stupid to not get your comment?
I think the argument might be it's you, it's the messenger. And I would go one step further. For the United States, if the U.S. administration used the language that Macron used in that conversation, if they turned around and said, we don't want to get involved in other people's crises, and they were talking about not Taiwan, but what was happening in Europe, on Europe's doorstep in Ukraine with Russia, what would the Europeans say back?
Look, in Ukraine, that would have been fatal. It would have been fatal for the Ukrainians because we know they care so much about what the U.S. does. We know what they do with the weapons. We know what they do with the funding. Obviously, Europe was wrong-footed by the timing of the war, the energy. They were still plugged in to Russian energy. When it comes to the weapons, obviously, we know they do, and they provide weapons for Ukraine, but it's smaller compared to the U.S. So that would have been incredibly fatal. And again, that goes back to the criticism to Macron. You can have many opinions. You can say, yes, we don't want to compete with the U.S., but we don't want to be a rival to China either. We want to be a third way in between. But you have to be able to back it up. And the issues are for Europe, well, on the weapons, they don't have it. We know that when it comes to the monetary and banking union, that's not completed. There's many visions of what Europe means. And also, I would say, when he speaks on behalf of the French Republic. That's very important to understand. He does not reflect the consensus on the EU, because I know there's many other politicians that are very angry about the comments that he made, particularly in Eastern Europe. That did not go down well.
Anne-Marie, what's the response been here in
Well,
DC?
you saw what Marco Rubio put on Twitter, the Senator Rubio, and to your point that not all politicians are happy with what he said, Marco Rubio certainly wasn't, and he asked, are you speaking on behalf of France or are you speaking on behalf of Europe? Because if you're speaking on behalf of Europe, we have a big problem. The U.S. is in charge of your defense, and the U.S. can also look at the comments you made about not being able to choose a side between the United States and Beijing when it comes to Taiwan, that maybe the United States should not be choosing a side when it comes to a European war, Ukraine. He says, I supported sending that money there. This is American tax dollar money. But if you're not going to back us, why should we back you?
Won't that be the argument in the presidential race, or at least on one side of the race here in Washington, in the next 18 months?
It certainly will. Ukraine will be a huge discussion point. We've already seen a lot of Republicans saying potentially we need to slow down some of this funding. Why are we spending all of this money on Ukraine? But also Taiwan. And how this administration versus potentially how the Republicans will handle combating China, and especially what happens in Taiwan, this will all be about 2024. But also to Maria's point, Macron, when he made these comments, the timing was awful. Not only was China just having military drills, if you look at what's going on right now, in this hour, they are continuing military operations. So the timing of this was really fraught for this relationship.
You know what, we're not talking about the mess in France And maybe that's some good news for Macron, just a tiny bit. AMH, Maria, to the two of you, thank you. Just the broader price action, unchanged on the S&P. Here's the sector price action. Here's Katie.
John, a quick look here. You have 7 sectors in the green, 4 in the red. Leading the charge to the upside is materials. It's healthcare. To the downside, once again, it's technology, down by 0.7%. This has been the theme of this week so far. Only 2 days in, that sector off by 0.9%, lagging the equal weight index. We'll see if that continues as some of these earnings kick off.
Katie, thank you. Thank you for that. Appreciate it. Coming up, your trading diary, a packed week coming right up. If you were looking for a day full of boring price action, so far so good for you. With one warning, it might change later this week. Look at this trading diary coming up. Fed speak throughout the day, Kashkari and Harker, followed by Barker and Daly on Wednesday. Plus the main event, US CPI and Fed minutes coming up tomorrow. US PPI and another round of jobless claims come up on Thursday morning, and another round of US retail sales coming up a little bit later in the week. On Friday's the big one. JP Morgan, Wells Fargo, Citigroup earnings to round out the week. From Washington, that does it for me. Thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
from the financial centers of the world. This is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Tuesday, April 11th. Here are the top market stories we're following for you at this hour. You got the Bitcoin breakout. Prices rally above 30,000. We're going to break down the recent move and the place it should have in your portfolio. And the money supply debate. The amount of money in the system is falling hard. What that means for inflation and growth. And the IMF's alarm bells. In its World Economic Outlook, the IMF says risks are weighted heavily to the downside. We're going to talk to its chief economist. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. And Guy, the headlines might come fast and furious, but really, volume is still light in the market. I do feel like, at least here in the U.S., we're going to wait for that CPI and then recalibrate.
Yeah. Look, the market seems super calm. You look at what is being priced in terms of expected swings when we get that inflation number, it's really quite limited. The market isn't expecting much here. Is this complacency? But yeah, I take your point, Alex. We are in a very oddly calm moment for these markets. It's interesting to see how much we're being pulled around by the Williams comments. We've got a lot of Fed speakers we've just been hearing over the next day or so, but it is about that CPI number, and then it's on to the big one later this week, earnings. Maybe the market just doesn't know what's going to happen here, and as a result of which, it is kind of like a rabbit in the headlights, or a deer in the headlights, doesn't know what to do. Rabbit in the headlights. The rabbit would be well away from the car at that point. But then it is interesting to see something like Bitcoin continuing to rally. And I say that because the NASDAQ has been losing some steam over the last few trading days while Bitcoin retains some steam. And that's interesting. Like, if we wind up seeing tech continue to sell off, does Bitcoin eventually wind up going with it? We will wait and see. It's interesting that actually volume has dropped out of that market as well. So post SVB, maybe actually what we're seeing here is a much lighter volume story. And we already know that Bitcoin is fairly whippy, and as a result of which maybe it's just being whipped around more than normal. But it is our question of the day, so let's get straight to it. Is Bitcoin back? Did it ever go away? Joining us now to kick this around, the one and only Kaylee Lines, the one and only Katie Greifeld. Thanks very much indeed for joining us, guys. Kaylee, I'm going to come to you. Why are we getting this relatively strong price action? What is the narrative that goes with it?
Well, there's probably a couple that you can pick from, Guy. On the one hand, there was the post-bank failure narrative that this is exactly why you should want your money in digital assets on the blockchain, because you have self-custody and you don't have to trust another financial institution that could fail. So that was one part of the narrative. The other being that because of those failures, it may make it more likely that monetary policy is actually going to ease, which could be supportive of these riskier digital assets. But you have to consider that a lot of this is probably psychological as well, Guy. Of course, we've been dancing around this $30,000 level for some time now. So once you got above it, likely more buying just kicked in purely for technical reasons.
Yeah, you gotta love round numbers in the market. Katie, what about you? Bitcoin back? Was it gone?
Was it gone? I mean, I will say to the question of whether Bitcoin is back, you aren't seeing tourists come into the market, if that makes sense. At this point, it really feels like it's the true believers. You can see that in the liquidity numbers that Guy referenced. Liquidity right now in the Bitcoin space is near a 10-month low. So it doesn't seem like you aren't seeing institutions come back. Some of those retail players who were flushed out haven't seen much interest in some of these crypto investment vehicles necessarily. So whether or not it's back in the sense that people are piling back into this asset classes, that remains to be seen. But in terms of just the price action, I mean, you can't deny that it was the best performing asset class in the first quarter, up 70%. And it looks like that has some follow through.
Okay, Katie, let's just kind of take a step back and think about where we're going next. I thought that Bitcoin in some ways was the poster child of excess money floating around the system. Speculative bubbles would build up. You think about tulips and you think about Bitcoin maybe in the same thought. We've got money supply going down really rapidly right now. Shouldn't Bitcoin follow if it is such a speculative asset? And if it's not, does that mean it's something different?
It's a great question because sort of the utility that I found out of Bitcoin as a journalist was that it was such a pure measure of risk appetite. I think it still has that characteristic, but as we're looking at the price action today, Bitcoin rallying, 4%? You have tech stocks under pressure once again. So it feels like perhaps the correlations that we've gotten used to that it has with traditional finance have broken a little bit, maybe as more types of players have left this market. But I think it's an important point that you make that money supply is going down. At the same time, you do have that sort of fundamental reason that there are, 100 basis points or so of cuts priced in, or they were at some point for later this year. That would theoretically be good for Bitcoin, even if right now it doesn't quite line up.
Right, Kaylee, and that kind of brings me to the point you were making about that it's moving in line with those rate cuts, because that's in theory what we saw prop up tech over the last few days. Obviously not today, Nasdaq 100 is off 0.4%. And I'm wondering, typically Bitcoin moves with tech, right? But I'm wondering if it's going to move more like gold now, or if it's still really that tech play.
Well, it's a good question as to whether or not that correlation is as strong as it once was. But I would also say, to the point about a lot of this being predicated on the idea that the Fed's going to start cutting rates, it also could leave it very vulnerable, just like tech potentially is now, post going into a bull market, to downside should the market actually be wrong and the Fed do what it says it's going to do, which is hold rates higher for longer. Because when we talk about the fact that there is really an absence of liquidity in digital assets right now, it means that not only are we vulnerable to volatility and big moves to the upside, but to the downside as well. So we could be primed for a pullback in theory if something market anticipation around monetary policy proves to be incorrect.
Is Bitcoin, Kaylee, different to the others? Maybe not Ethereum, but Bitcoin different to Doge, etc. now? Are they on different pages? It was fascinating to see when we saw the Doge icon appearing on Twitter once again. Things kind of went a little crazy there. Are we now thinking of Bitcoin as a different asset to those others?
I think we have been thinking that for some time. I mean, even when you speak to more pro-crypto people who follow digital assets very closely, they kind of categorize a word I will not use, but altcoins differently from the likes of Bitcoin and Ether and some of those main ones that are, far larger in value. Because as you allude to, Guy, you have something like Dogecoin, which literally just trades on the whims of Elon Musk. So that isn't necessarily tied to anything fundamental. Perhaps for these larger cryptocurrencies, it's more so. And when you look out to the future, there's a question on what percentage of the digital tokens that are currently out there are actually going to be ones that survive when they're not actually tied to anything tangible. Yes, Bitcoin isn't either, but that's probably not something that's going to go away.
So, Katie, can we safely say that the Sam Bankman-Fried sort of shadow is gone now from this market?
Well, that's the interesting part. If you look at the actual tokens, the actual coins, it feels like they've been trading disconnected from what's actually going on in terms of the fundamentals of the space, if you will. Of course, what happened with FTX, and of course, going back, what happened with Terra USD, etc. But I will say that had really been dragging down the equities as well. But really in the last quarter, you've seen some of the crypto miners in particular, the Bitcoin miners, really outperforming Bitcoin itself, which, I mean, that has to raise eyebrows. Because if you think about the margins on these miners, obviously they've come down quite a bit with the price of Bitcoin. But then you look at, for example, Valkyrie has a Bitcoin miners fund. WGMI is the ticker. It was up 130% so far year to date. Whether that actually makes sense remains to be seen, but it does feel like it's disconnected from a lot of the headlines we tend to see about what's going on in the crypto industry.
Good deal. Hey guys, thanks a lot. We super appreciate looking for the crypto show. Also, Katie Greifeld and Kaylee Lyons and Bloomberg Crypto will be coming up at 1 p.m. New York time, so don't miss that with Kaylee and Matt Miller. All right, some breaking news for you. Megan Green, the global chief economist for the Kroll Institute, will be appointed to the BOE Governing Council. She will be a voter on monetary policy. She will be replacing Guy Silvana Tenreo. A big shift now, big move for the BOE.
Yeah, we've all known Megan for a very long time. I remember spending a great deal of time with her during the Greek financial crisis. She has held many eminent positions. She is qualified for this position. She went to Oxford. She went to Princeton. She is incredibly smart. I'm fascinated to see ultimately where she sits in the dove to hawk spectrum ultimately. It'll be fascinating to find out. But yeah, no, I think a very smart appointment at the Bank of England.
I do think that I was reading back on some of her comments on the LDI pension crisis that happened in the fall, and just talking about how if central banks continue to have to step in to paper over market dislocations, it is going to wind up affecting how central banks are ever going to lean against inflation and undermine that and sort of affect inflation expectations. So I also thought that that point was quite interesting in that regardless of hawk or dove, kind of how do you manage the issues that we see around financial instability as rates are hiked around the world? I think that part was kind of interesting as well.
Absolutely, and that incredibly germane at the moment as we see what we see in the US banking system and the impact that that's ultimately going to have and how the Fed is going to be dealing with this. The expectation is you are going to see more, and certainly maybe the Bank of the UK's LDI crisis was a bit of a pre-shock, but there are going to be more. So yeah, if she's certainly thinking along those lines, it's going to set us up for a fascinating debate.
All right, she's coming to your, congratulations, Megan. Congratulations, Megan Green, a friend of the show, a friend of Bloomberg TV, becoming governor of the Bank of England. Go on a guy's side of the pond. Coming up, we're going to stay with Bitcoin here in the market. Mark Connors, a 3IQ head of research, joins us for more insight on our question of the day: is Bitcoin back? That's next. This is Bloomberg.
The market, to Tom's point, is very much already pricing in a soft landing and quite a lot of optimism. Remember, the first quarter, the US was up 7%, the strongest we've seen at the beginning of any year since 2019. So I think there's still risks for the market.
That was Peter Oppenheimer, Goldman Sachs Chief Global Equity Strategist, earlier on Bloomberg Television, which brings us to the question of the day: is Bitcoin back? Joining us now with his take, Mark Connors, 3IQ Corp Head of Research. I feel like you're going to say yes, but tell me why you think it's back, kind of what role it should play.
All right, so why is it above 30,000? Why is it up 70% this year? The other headline today, you mentioned about Bitcoin being, is it more like gold or tech? Look at the M&A activity today on the gold miners. So there's gold activity. The
Newmont and Newcrest potentially, is that what you're talking
exactly.
about?
I think that got upped again a little bit on the bidding. So the miners are back there, just like the miners are back in Bitcoin. Bitcoin went through its default cycle last year. You know, you asked, is Sam Bankman-Fried in the past? His legacy will be that now we'll have legal precedent on how to handle exchanges, custody. in Bitcoin. We needed that. We didn't have it. So his legacy, he didn't mean to have it, is that now we have more of a firm grounding of rule of law on how to deal with these firms. So Bitcoin is back. The tourists got flushed out, and the Treasury and Fed are not helping the case for the dollar versus Bitcoin for sure.
Mark, let's unpack that last bit in just a moment. But first of all, let's stick with Bitcoin as a investment. Great to see you, by the way.
Yes.
Is it still too whippy, though, to be an investment? Is it not still a speculative asset? It's got incredible volatility still attached to it.
It's a speculative asset in terms of volatility for sure, and in terms of adoption. You know, it's, people say between 100 to 200 million people have it. You know, there are close to 8 billion people on the planet. Only, you know, 2/3 actually have accounts. So you got to walk that number down. So to answer your question, a little bit. You know, we never say buy it. We say read about it. Read the book Digital Gold by Nathaniel Popper. First one you should read. Then go to our website and read our research, and we'll get more technical. Because it is volatile. And yes, I believe the adoption is there. I think it's going to be the next reserve asset in addition to gold on the layer of all central banks.
So should we be careful, though, if Bitcoin or crypto starts tracking tech again? Like, I hear you on the gold front. If it starts to track more one-for-one for tech, is that a bad sign?
It is not constructive.
Okay.
So when we saw that happen for, say, May to November of last year, when it went from 60 to 80, and now it's back down, you know, that was part of its cycle. So let me step back. Bitcoin has followed a cycle of 3 up years and a down year, related to its halvening. Think of its halvening as a reduction in supply. There are only 21 million coins, probably less now because some have been lost, that will ever be out there. Every 4 years, that supply that goes to the miners for monitoring the decentralized network, it goes down. So that's very different than what the Fed is doing, Guy, back to what you alluded to on the Fed and other central banks using dollars to cure every problem, which is not exactly a long-term plan. So that's why Bitcoin's going higher. Think of the race.
Mark, what's the relationship between such an asset and money supply? Money supply is cratering right now. I'd be interested to get your take on that and what the implications are. But what does money supply mean for speculative assets? In theory, when there's a lot of money floating around the systems, you get speculative bubbles. We are now getting the reverse. Shouldn't, therefore, we be seeing some of these assets getting hit hard?
And it did. So money supply cratered. Well, the largest ever one-year decline last year through November, I think maybe December, 1.7%. That doesn't sound like a lot, but we can't afford it. That's the largest contraction ever. So, Guy, that's in the rearview mirror. When we look at money supply, we're now looking at, in 2023, the money leaving the banking system and going into money markets. It's still there. It's not being fully pulled out of the system. So I would say that it's a bit of a red herring to say that money supply has declined. But you're right in that the banking system is declining. So I think when you look at Bitcoin, it's also an alternative to the current banking system, which by any measure is contracting.
Yeah. So based on that, what is the sentiment then in the market? It's like we're all trying to prep for whatever credit crunch we're going to get. There are signs that we're already starting to see that in terms of lending, the SLOOS data from the Fed, for example, senior loan officer surveys. But then, like you said, a lot of it's going to money markets or just shifting, right? So like if you need it, it's there.
Yeah.
So how do you think about that when you're trying to determine how much risk you should have on?
This is an unlevered low-risk market. So we're not suggesting that people put on 25% Bitcoin, Ethereum, and stable coins. Those 3 assets are 75% of the entire digital asset universe. So when we talk about altcoins, just put them to the side for a minute. It's Bitcoin, Ethereum are about call it 50%, maybe, yeah. And then stable coins. This market, think of the last time we've had a recession, a mini recession, was 2016. Remember, oil cracked down to 25 bucks, and all those companies refinanced. That's what's going on in banking right now. It's not going to be a 2008, but it's going to be painful. Banking's going to go through. It'll be smaller. It'll be more tech-driven, and I believe Bitcoin will get more adoption because of it. Think of the countries in EM that never put up telephone poles. They went right to cellular. That's what's going to happen.
Okay, Mark, let's figure out what therefore we should be doing our money. The banks are struggling. It's going to be interesting to see what impact that is going to have in terms of what happens in the real economy and the data and how the Fed is going to react to that. As you say, there's a lot of dry powder sitting in money market funds. How should you be positioning right now, given that scenario? Should we be, is downside limited? Is there a lot of upside because of the money market funds? Do we know what earnings are going to be doing? Give us your kind of, in a minute, tell me what I should be doing with money right now.
All right. So the ideal portfolio has much more cash 2 years in. That's optionality because we don't know what's going to happen. I do believe there's going to be a banking consolidation. It'll be an earnings decline across all S&P. So we believe that's going to happen. So whether you're 2 to 5% cash, you may double or triple that number. Let's start there. Should you be out of equities? Good luck finding a way to grow value over time without equities. Bonds, I believe you still have to have some. They've disappointed for 3 years. I think they're going to continue to rally, especially in the long end. So it's almost like a 60-40 portfolio. And of course, it wouldn't be a Bitcoin day if we didn't say just adding a little bit of Bitcoin or Ethereum after you've done your work so you can handle the volatility is a suggested path, absolutely.
Hey, Mark, it's always good to catch up. Love having you on set. Mark Connors, 3IQ Corp, Head of Research. Thank you very much. All right, coming up, we're going to stay in tech. Alibaba getting into the AI game, rolling out its own ChatGPT-like product. We're going to have some details on that next. This is Bloomberg. It is 23 past 7 on the West Coast. Why not get to the startup where we cover the top tech stories from the Bay Area and beyond as Silicon Valley starts its cloudy morning. Joining us now is Bloomberg Technology co-host Ed Ludlow. All right, Ed, let's go to ChatGPT. Alibaba is now entering the fray. It's trying to integrate some of its AI features. Walk us through what Alibaba's doing.
Yeah, so this is like the official moment, right? Daniel Zhang, the CEO, on stage, and he is kind of given the outlines of how Alibaba is going to use their large language model, which is called Tongyi Chenwen, which kind of loosely translates to truth from 1,000 questions. That is their underlying technology, but they're using it in two ways. The first is in a tool that's kind of similar to Slack. For those of you in the audience who are a Slack user, their version is called DingTalk. The other is in their hardware. They have a sort of series of home smart speakers, very similar to Amazon's Alexa-powered products, where they'll use it there. But it's interesting because, you know, they're kind of last in the list. You know, Tencent's kind of already put what they're doing out there. Baidu with Ernie have already played their hand, and then SenseTime were 24 hours ago. So the arms race around AI in China is now really heating up in terms of how they're deploying it.
Ed, there has been much speculation about whether or not we should take a pause with this technology. Elon Musk has talked about that, as have many others. What are the chances that the Chinese pause? If the US was to pause, would the Chinese simply leapfrog?
It's a real question, because the other big piece of news overnight is China's cyberspace administration, a government body that essentially looks at tech regulation, coming out and making a series of proposals and guidelines about how tech companies have to basically keep within the confines of standard sort of Chinese oversight of technology. You know, it's really interesting. If you look at the Bloomberg Intelligence React deck or research to that move, they're pretty sanguine about how that will have an impact, because what the CAC in China is basically saying is all of the existing censorship and rules that we have for tech, big tech companies, those need to be carried over to the field of AI, making sure that there is control over the data security of AI, and also some of the ethical considerations as well. So, you know, we see this playing out in the United States as well, where basically third-party regulators or government bodies are saying we should probably start talking about a common set of guidelines for how AI is governed.
Ed, great stuff. Thank you very much indeed. Yeah, we're just in the foothills of this battle, it seems. Ed Ludlow joining us from San Francisco. I learned something new from Ed today. Apparently in San Francisco they call fog Carl. Fine, yeah, why not? Got to come up with a name for something. Yeah, Carl.
Carl.
I'm sure I'm mispronouncing it. Apparently the English,
you say it funny.
the British have a strange way of saying it. Anyway, Ed's going to be back a little bit later on. I'm sure he'll talk to you much more about this a little later. Bloomberg Technology coming up in around 90 minutes at noon Eastern. This is the serious stuff, 5 p.m. here in London. That's pronounced London. Anyway, coming up, the IMF is trimming its global growth forecasts, Alex. We are going to be speaking to the IMF's chief economist. This conversation is coming up. This is Bloomberg.
We're an hour into U.S. trading session, trying really hard to get pumped up, but man, that price action's boring. Kriti Gupta is tracking the move.
Yeah, just
move. I just say move. I don't think
say move. Singular, hand off all the hard work to me. It's fine. I'll take it. Look, the S&P 500, it is unchanged, but I am excited about it because, look, there's some cool charts I'm about to show you. Really, the question is all about, are we talking about inflation, recession? What's the real risk here at the core of it? And I think the way that you're seeing it best played out is not in the S&P 500, but the S&P 500 equal weighted average, which basically means your Apples, your Microsoft, et cetera, aren't tilting the index in one way or the other. If you look at it by an equal weight perspective, that index up 0.6%. There's the action Alex is so missing, Guy, when we talk about what's going on in these markets. The two-year yield also virtually unchanged, but look, it's all going to change tomorrow when we get that inflation data. The Bloomberg Dollar Index slightly weaker, but again, a mid-thin volume. Everyone is waiting for the data tomorrow at 8:30 a.m. But again, I want to go back to that equal weight outperformance because look, if you are worried about recession in any way, or if you are betting on a global turnover or turn down, I should say, where you do see the United States perhaps outperforming in recessions, you've seen that fund flow come to the U.S., then it kind of makes sense to be a little bit more positioned or skew your portfolio towards the United States and specifically towards the entire index rather than just your tech heavyweights. And that's kind of what you're seeing in terms of fund flows. This chart shows the outperformance of the equal weight index relative to the S&P 500, and you've seen that in play for 2 weeks now. Ahead of the inflation data, that is a really important fund flow to be watching. That's not the only macro story. Look, because you have a lot of action underneath the hood, and pun not intended, CarMax is one of them. They reported earnings this morning. You are seeing a little bit of movement higher by about 8%. This is the action that you guys are missing. They came out with earnings. Remember, we talked a lot about CarMax when we were talking about used car vehicles, how that was driving up the headline inflation. Well, CarMax says, look, they're still profiting from it, and that is really helping their bottom line. On the other hand, that inflation story, specifically the labor story, showing up in the likes of Albertsons, for example, down 1.4%, where they're talking about a tough environment to retain labor, enough to weigh down the stock by 1.4%. I'm going to end here, Guy and Alex, with the macro again, because again, we're keeping an eye on the bond market, but we're also keeping an eye on how you position if you're worried about a turn down. And that is where the two-year yield is really significant. That's kind of this, well, you don't see it right now, but the two-year yield mirrors this exact trend, essentially where consumer staples, this orange line, is outperforming the white line. And that really tells you that at the end of the day, people are going to stick with their consumer staples, the goods that you need over the goods that you want to have. And if you were hypothetically to overlay the two-year yield, you would see the exact same trade, which at the end of the day, the message that you need to take away is that people are worried about recession, and it's showing up in the markets.
It certainly is. They're not worried about the CPI number tomorrow, though, because if you take a look at the market positioning right now, in the options market, the market's basically positioning for a 1% move either way, i.e. not much volatility around that print. Pretty fantastic as ever. Thank you very much indeed. Let's stick with the macro. The IMF lowering, let's call it trimming, its growth outlook, in large parts thanks to its concerns around the global banking system and the recent shocks that we have seen. In its latest World Economic Outlook report, the fund's chief economist, Pierre-Olivier Gourinchard, says, quote, the risks are weighted heavily to the downside, in large part because of the financial turmoil of the last month and a half. Pierre-Olivier joins us now from Washington. Thank you very much indeed for your time. We always appreciate it. Pierre-Olivier, I read what you wrote, and I see you trimming your baseline forecast by a little bit, but warning the risks are heavily, as we say, heavily skewed to the downside. Does that mean that I should be reading your baseline as being potentially over-optimistic?
Well, no, I mean, the baseline is the baseline, so that's still where we believe that things might unfold. And as you pointed out, it's a slight downward revision for this year and next year at 2.8% and 3%. And this is reflecting basically the fact that we have, advanced economies are reopening, are moving ahead, China reopening, and at the same time we have the tightening of monetary policy that is weighing in, plus a little bit of financial instability that could weigh down on bank lending, for instance. So you put all of this in the mix, and that's where you have our baseline. The concern we have is that there could be a lot of things going off the rails, if you want, and in particular in the financial stability space. And so that's why we offer, in addition to the baseline, two other scenarios where we amp up, if you want, financial instability, and we look at the consequences might be.
So let's talk about the consequences when it comes to, say, SVB and Credit Suisse. How do you think about that?
Well, very clearly, what we are seeing is with a very sharp increase in interest rates by central banks around the world in the last year, that's creating pockets of vulnerability in the financial system, both in the banks, as we've seen with SVB, and in the non-banks. We had the UK episode last fall with the LDIs, the liquidity-driven investments. And so we have to be vigilant because some of these pockets of vulnerabilities could spread, and then they could spread to the whole financial system. Now, this is not where we are, and the authorities have been dealing with that. But what we are seeing right now is the risk that banks are going to look at the outlook. They're going to look at their bottom line. They have to pay more for deposits. They're losing deposits. They're booking losses on the asset side, on the holdings of long-dated fixed income assets. And they're going to be a little bit more prudent in extending loans going forward. And that could weigh down further on economic growth, both in the U.S. and in the rest of the world.
If we get that credit tightening, if we get that potential credit crunch, Pierre-Olivier, how quickly does that show up in inflation? What is the relationship in the way you're looking at this, your models are showing it, between tightening credit standards and inflation coming down maybe potentially more rapidly?
Yeah, well, this is the other part of the story. We've seen inflation being more persistent, stickier than we'd like. And to some extent, this contraction in lending, if it were to happen, it would knock off a little bit of the growth. We estimate that, if we have a contraction of lending that's about 2% of real lending, then that would knock off about 0.3% of output this year, bringing growth to 2.5%. And it would moderate a little bit inflation pressures for this year and next year. So he would, in a sense, substitute for more monetary policy tightening to some extent.
Right. But yet, Pierre-Olivier, the markets are pricing in cuts, at least when it comes to the Fed. In that scenario that you just laid out, will central banks be able to continue to hike, or will they hold, or do they need to cut?
If we have the type of contraction in lending I just described, about 2% of contraction in lending in the U.S. and in a number of other advanced economies, our projection suggests that then the Federal Reserve would be able to cut rates modestly by maybe, we estimate, about 40 basis points. What's important to realize that this is in response to a softening of the economy because of the contraction in lending. This is not because of some concern about financial stability per se. It's responding very narrowly to its mandate, which is to try to achieve a certain stance of monetary policy to bring down price inflation.
Pierre-Olivier, there are still a number of significant tailwinds for the global economy. You're describing headwinds. We have a Chinese economy that is reopening. Europe has weathered its storm on the energy front relatively well and looks well set up going into next winter. There's a number of tailwinds that are currently impacting the global economy. To what extent does the credit tightening that you're describing, the rising cost of money that you're talking about, offset some of those benefits? And where do you think the balance currently lies in terms of the tailwinds and headwinds?
Well, this is how we define our baseline. You're absolutely right. It's not just all downwinds or, headwinds, because we have, in particular, when we look at emerging Asia, look at China, you look at India, we have very strong performance this year and into next year. The reopening of China, we anticipate a growth rate of 5.2%. In India, there is a slightly lower growth rates for 2023, but it's still very robust, close to 6%. And so these two countries, large economies growing at such rapid rates, this is really pulling the rest of the world along. So you are absolutely right. On balance, we have these concerns about contraction in lending, but we also have emerging market economies powering ahead. And we've had quite a bit of resilience, as you point out, in European economies to the energy crisis and the impact of the Russian invasion of Ukraine.
So this sets me up nicely to talk about the energy transition, because if what we're seeing in Europe is sort of a really speeding up of the energy transition, and I'm wondering how the IMF is looking at that in terms of growth. You're going to see a lot of trade flows are going to be disrupted. It's also going to lead to more reshoring and onshoring and a huge disruption of the energy market. How do you guys model that? What's the effect on growth and inflation?
Well, we look at that fairly closely, and we actually did a whole study of this in our previous World Economic Outlook back in October, where we looked at the short-term impact of the climate transition, in particular the impact it could have on inflation and growth. And we found that there were some modest effects. You know, it would increase, the climate transition is going to raise the cost of energy, at least in the near term, because you need to substitute and move away from carbon-based sources of energy. That's going to increase the cost of energy, and that's going to feed into inflation. But the effects was relatively modest and certainly could be absorbed and could be dealt with. So we do find this effect. Now, when you look a little bit under the hood, you find also a lot of heterogeneity across different regions. What we did in the current World Economic Outlook, we have a special focus on those countries that are, you know, large producers of fossil fuel energies, whether they are oil or gas or coal producers. And we look at what happened if they have to quickly pivot away from this sort of extractive source of growth. And we find that the effects on these countries could be actually quite large and negative, both in terms of the decline in output, decline in investment, a worsening of their trade balance, a depreciation of their currency, and even the manufacturing sector, which in some cases, when you're a commodity-driven economy, your manufacturing sector suffers. Well, we found that in many of these countries, the manufacturing sector, because it's so specialized around energy production, would also suffer.
Interesting. A lot more to come on that. You're speaking my language now. All right, Pierre-Olivier Gournichard, thank you very much, IMF chief economist, for joining us. All right, coming up, one risk in the market could also come from commercial real estate, but BlackRock is now betting big on real estate. We're going to have Blackstone, I should say. BlackRock is different. Blackstone, we're going to have details on the company's newest $30 billion deal next. This is Bloomberg.
Keeping you up to date with news from around the world, here is the first word. I'm Simone Foxman. President Joe Biden is traveling to Belfast in Northern Ireland today, where UK Prime Minister Rishi Sunak is expected to greet him as he steps off Air Force One. Biden will also travel to Dublin to mark the 25th anniversary of the Good Friday Agreement. However, a recent leak of allegedly classified Pentagon documents about the war in Ukraine and U.S. spying may cast a shadow on an otherwise celebratory visit. In North Korea, Kim Jong-un has called for what were described as practical and offensive war capabilities. That came as Pyongyang cut off communication links with South Korea that are used to reduce tensions on the border. This year, North Korea has tested new weapons and systems to deliver nuclear strikes against the U.S., South Korea, and Japan. Russia will expand the penalties for draft evaders. That's aimed at fixing the problems exposed in last year's mobilization of 300,000 reservists to fight Ukraine. Under the new plan, draft evaders will be banned from leaving the country, getting driver's license, buying and selling property, and taking loans. Global news, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Simone Foxman. This is Bloomberg. Alex.
Simone, thanks a lot. All right, let's back to that one of the breaking story of the day. Blackstone raising over $30 billion for its largest global property drawdown fund, targeting deals across all areas of real estate. Bloomberg's Wall Street correspondent Shalini Basak has some details. This was surprising because we're all waiting for commercial real estate to implode. Is this targeting that area at all? What did you make?
Yeah, I mean, firms like Blackstone in particular, has really gained from periods of market volatility. Now, they also feel some of that pain. We could talk about that in a second. However, raising money at this time, the largest ever $30.4 billion drawdown fund in real estate, gives them the opportunity to really capitalize when we see that kind of inevitable drawdown in pricing that we would see in the market. The thing about Blackstone, though, is that they're not investing in some of the classic real estate places that you would think. They, I was joking with somebody yesterday that, the office is dead to Blackstone. While that's not quite true, it is the case that they have largely shied away from large office buildings, malls, and have really leaned into other things like logistics and rental housing, student housing, and things tied to many cash flow generating industries like biotech. So that's the big play here when you look at Blackstone and what they're trying to accomplish and why they've raised all this money.
Shalini, who's putting money in and what kind of rate of return do you think they're looking at?
Yeah, this is an interesting question here, too, because I think you have to look at two entities here. You have big institutions putting money into Blackstone's, big drawdown fund that we see here. These tend to be institutions that can lock up money for a long time. But we talk about this at a time where we're talking a lot about BREIT. This is that interval fund that everyone has been talking about. This is a separate fund that you're able to redeem money from, Guy. So when you're looking at, for example, BREIT returns, you're looking at returns that have been 12.3% over time, but a little less than 6% over the last year. And I look at BREIT for a second here because we are looking at these big money managers as they're courting both high net worth individuals as well as these large institutional investors, some of which are also in BREIT, this interval fund. And the question then becomes, is it better to lock your money up when you're thinking about the kinds of funds that you're thinking about that'll invest in real estate, which is a particularly longer time horizon here?
I just wonder about the knock-on effects. I appreciate that this money is going to be in healthcare, student housing, stuff that should be safer and that has a longer growth potential. But if the commercial real estate market really seizes up and if banks seize up and the maturity wall comes and everyone kind of gets squeezed, is there the potential of a trickle down, or are we just going to keep hearing, I have a long investment horizon, I'm okay?
I think that there's certainly an event of a trickle down, and that is the question you draw for Blackstone's existing portfolio. What does it mean for the returns that they're making on the assets that they already hold? What does it mean for potential defaults among people who are within those buildings and the ability to generate cash flow? However, I would also say some of the places that are already seeing stress, like iBuyers, for example, where you're already seeing pricing drop off, you're seeing firms like Blackstone really be able to dive into that opportunity and buy things on the cheap. So the net return coming out of this period will be very interesting.
Let's talk about the drawdown and how this whole thing is structured. How nimble do you think this fund could be? You talk about being able to dive in. How flexible, how nimble could this fund be? How many layers of decision making are we talking about here in order to be able to pounce on some of these opportunities?
I think that's a great question, because you think about Blackstone, for example, and Blackstone now, Guy, you have to think about the scale of this business. This is a business that is more than a third of Blackstone's total assets under management. It is a huge business. And when you think about it, John Gray, who is the president and COO of the firm, this is where his heart lied. This is where he really made his name. Kathleen McCarthy, they work very closely all together here. So if you're thinking about bureaucracy within Blackstone, it's pretty nimble when you look at how they manage these real estate businesses. So to the point you're making, they can pull up multi-billion-dollar checks in a hurry if they want to. But again, I think what people are looking for here in the market overall, Blackstone are not with the industries that they like, or other industries, to commercial real estate's point here, the other investors that are looking, is the clearing price. Things are still kind of volatile, and I think it's a little uncertain here at what prices assets are going to be acquired for at the best price.
Absolutely. We've already seen some significant clearing taking place, maybe more to come. Sonali, great stuff as ever. Thank you very much indeed. Bloomberg Sonali Basak. Okay, coming up, we're going to hear from Treasury Secretary Janet Yellen next. She's going to be speaking in the next hour. She's talking about the banking crisis and what is happening with the world economy. We'll have a preview of what we can expect to hear from her next. This is Bloomberg. So in the next hour, the Treasury Secretary Janet Yellen will hold a news conference as the World Bank and the IMF spring meetings kick off. She is expected to give her outlook on the global economy. She's also expected to speak about the banking crisis. Joining us now, Wendy Benjaminson, Bloomberg's Deputy Managing Editor and Head of Bloomberg's government team. Wendy, we've just been speaking to the IMF's chief economist. He was playing up, highlighting the risks emanating from the financial sector, from the banking crisis that we have just seen. I understand that Yellen is going to do the exact opposite and try and play down those risks. How big a political risk is she running in doing so?
Well, I think if she's playing to the domestic political audience, she's doing exactly what her boss, Joe Biden, wants her to do. It is rare for Janet Yellen to give a news conference, so we in the news business are kind of excited about it. She is arguably the most important finance minister on the planet, so to get to ask her questions is really a big deal. In her opening remarks, a preview of which we have seen, she is talking about how the economy is in a better place than many predicted it would be last fall. fall. She's touting the Biden administration efforts with the Inflation Reduction Act to bring inflation down. She doesn't mention the recent rise in oil prices, which will affect voters this summer. But she suggests there are some clouds on the horizon regarding both the banking crisis and China.
So what do we think the questioning and the line of questioning is going to be? These things tend to be really partisan, right? What's going to be the line drawn?
Well, I certainly hope the reporters aren't too partisan. We're not supposed to be, but she will. I'm sure she will be asked about the banking crisis, any lingering effects on the economy or on investing. She will be asked about interest rates and inflation, and certainly she will be asked about China, especially in light of the recent leaks of intelligence documents that are all over the internet right now, and we don't know the provenance of that. But it's creating tensions with both allies and adversarial countries around the world, so I'm sure we're going to ask about that as well.
Wendy, we're all looking forward to it. We're looking forward to some great questions. Thank you very much indeed for setting us up with a preview. Wendy Benjaminson joining us ahead of that Janet Yellen press conference. We're ahead of the European market close. We've got around 34 minutes to go until that happens. European stocks are generally well bid. We're a little cautious going into the CPI print. I think most markets are as we await that data. But we are seeing miners on the front foot today, a whole range of them actually outperforming, which is interesting. Jerry Fowler, we're going to be speaking to him very shortly from UBS. He actually favors the oil stocks over the mining stocks. The euro on the front foot as well. We're reapproaching the 110 line, which has been so tricky. Can we get through that? Can we punch through it? Can we go much further than that? We're up by around 0.5%. The dollar generally on offer today. We are seeing yields rising. That's the German 10-year. We're up by 12 basis points today, as you can see. So the bond market is on offer. We are waiting this data just to get a real sense of where the Fed ultimately is going to go next. The market is not set up for fireworks tomorrow in any shape or form. Anyway, we're going to talk about that a lot in the next hour. Jerry Fowler, as I say, UBS's head of European equity strategy, is going to be joining us. Looking forward to that conversation. This is Bloomberg. Tuesday, the 11th of April, Europe is back, but not with a bang. We're up a little bit. We're waiting in reality for the US CPI data tomorrow. These feel like cautious times. The market's not doing very much. What kind of a session are we going to have tomorrow? The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
So at an index level, relatively cautious. We're trading 461. We're up by around 0.5% today. Single stocks, I think, are quite interesting. The miners are generally having a fairly good day as well. There's a bunch of banks that I think are worth focusing on. UBS, some very positive notes out on UBS. People, I think, are beginning to get their arms around the potential implications of this deal. We have seen the Swiss government being interrogated by MPs today on the deal that was put together. But I think as people sift through the numbers, maybe we're starting to see a much more positive spin being put on this, and UBS responding to that today. I mentioned the miners, Alex, we're up by 4.9% today on Antofagasta, but basically it's a pick your big miner day today because they're all having a relatively good session.
Yep, Glencore actually upping its bid for tech. We'll talk about that in a moment as well. All right, here in the U.S., I got to say, headline level, it's pretty boring. Tech is down, NASDAQ 100 down 0.7, S&P pretty much going nowhere. Volume's also light. Just the tech volume's a little bit higher, but overall, volume's pretty sad. CarMax, though, is up 9%, and it's also the best performing stock on the S&P. And this was rather a surprise. They were able to squeeze more profit out of each car that they were able to sell, which is quite impressive considering the softening used car market prices, plus just an overall sales malaise. So good news, maybe not priced in just certain areas and certain stocks on a micro level. Bitcoin, we were talking about earlier, up over 30,000, but well off its highs. I still question, is it following tech, or is it following rates, or is it on its own now? It's hard to distinguish. The two-year yield up by about 3 basis points. Now we're definitely over 4 as we head into CPI Wednesday, Guy.
Yeah, and what is the relationship between money supply and inflation? That is certainly something the people, Alex, are conjuring with right now, trying to understand the relationship. Hugh Pill, the chief economist of the Bank of England, once wrote tongue-in-cheek, I think it was a speech that he gave, what did the monetarists ever do for us? Obviously, there's an element of Monty Python within that. But what did the monetarists ever do for us? Well, the 1980s was dominated by them. But if you look at this chart here, what they did do was maybe predict the inflation that we're dealing with now, because we got this huge surge, and this is Eurozone we're talking about here, Eurozone M3, peaking kind of back end of 2020 into 21 as we went through the pandemic, this huge amount of money that was thrown at the system, then started obviously to feed the inflation story. Now, is that coincidence, or is that a correlation? Are those two events related? Well, I think what we're trying to figure out now, Alex, is whether or not the answer is yes or no. And maybe we will know as money supply rolls off rapidly, we will find out whether or not it will bring inflation down with it. And I think it's an open question at the moment, but one that a lot of people are trying to figure out and are paying an awful lot of attention to, because money supply is rolling over relatively quickly, and this is on top of already this bank credit crunch that potentially we could see.
Or is just going to money market, so it's a different kind of decline. Anyway, lots of fun things to talk about with that. Panmure Gordon Simon French is not convinced, though, by an undershoot in inflation. He was on TV earlier today.
They got it right on the way up. The question is, of course, for an investor to be valuable, for this insight to be valuable, it's got to be right on the way down. And they are right to say the monetary aggregates really around the world are now slowing at a very rapid rate, and there's a fear of an undershoot in terms of inflation. I don't actually see that, even though the monetary aggregates are pointing in that direction.
So that brings us to our question of the day. Is money now too tight? Have we tightened the money supply too much, and should central banks be turning tail and cutting rates? Let's try and answer that question. Marcus Ashworth of Bloomberg Opinion joins us here in London. In New York, Bloomberg International Economics and Policy correspondent Mike McKee. Marcus, I'm going to turn to you first of all, because you're standing next to me. So let's start the conversation off. What did the monetarists ever do for us? Well, they predicted potentially the inflation that we're seeing right now. Are they going to be able to predict a rapid decline in inflation on the way down? Are these two things related? Because a lot of people are making a lot about this drop that we're seeing in the money supply.
Yeah, I think that's why I know what Simon French is going on about. The related point is the key bit, because you can hike interest rates or you can have financial conditions tighten separate to what you're doing with interest rates, which we're now getting that twin effect.
The availability of money.
Yeah, in a sense, it is the availability of money, but it's a bit more than that. It's just also the demand for money as much as the supply of it. So, and that I think is where we're seeing a fall off in the demand. People are repaying debts because interest rates are going up. They're not looking to borrow more loans because it's too expensive. Combined effects, which we will not see fully pass through for months, quite a lot longer than perhaps the central banks are prepared to tolerate at the moment, is risk a point where they hike interest rates without realizing the added effects are coming through. They need to wait and see what that lag effect might be. So the point here is that neither Keynesians nor monetarists are solely right. You have to look at both. And I definitely think money supply is something which has been ignored for too long, and we need to be taking much more interest and care into it.
Okay, Mike, you weigh in. Is money supply too tight? Do we need to be paying closer attention?
Well, for the most part, I agree with Marcus. We're talking about sort of two different things in the U.S. and in the U.K. The fundamental issue of the governments giving more money to people and there being more demand for cash is true. But in the U.S., we also had an enormous amount of demand for dollars from all around the world. So between the stimulus programs we had in the U.S. and the demand for dollars around the world, the money supply went way up. I'm using M2. One of the issues that you have is these things are not comparable. The M versions in the UK are not the same as the M versions in the US. And so now that people are repaying loans and that the government is no longer sending out money, and a lot of this money has now gone into the economy and gone out, it's going to roll over. The velocity of money has picked up, which suggests that growth is picking up, but inflation has also picked up. Now, you can make an argument that it was, to a certain extent, the growth in the money supply, because, of course, we saw a lot of money go out at a time when demand was going up and supply was constrained. But that's not, wasn't a normal supply situation.
So, Mike, you make a really good point about the supply side. To what extent is the inflation that we're dealing with now to do with that supply side shock that we experienced as a result of the pandemic and other factors coming into play? The deglobalization element is also not to be ignored. And how much of it is the sort of the monetary side of things? To Marcus's point, we have kind of a whole range of factors coming together. How can we separate out the supply side and the supply of money to get a better understanding of how quickly inflation will fall from here?
Well, it's not easy to do because a lot of the demand was artificial demand for things that you couldn't get during the pandemic. We started off not being able to get medical supplies or masks or things like that. And so prices went up for a lot of goods that were constrained by supplies. Now supply chains have somewhat normalized, but people are spending a lot of money on services, and that's not a supply issue. It was an absolute absence of supply, but now that's coming back. So demand, that may be part of the reason that we're seeing velocity pick up some and inflation picking up because of the labor market shortages. But whether you could go back to really looking at money supply, most people at the Fed would say you can't here because there's so many different kinds of money, things that substitute for money, that there's no real way to measure it. I mean, you go out and spend something on your American Express card, you get Amex points. You can go on Amazon and you can buy what you want with Amex points. Now, is that money? It functions as money, but it is not something that is controllable in terms of supply.
Yeah, and that's not even taking into account like crypto coins and how we deal with that. Marcus, I get that point that Mike is making. However, if we were able to draw an economic conclusion, you were saying, yeah, I think we're getting a little too tight. Where are we tightest?
Well, I'm very glad Mike answered the last question, but the point here, I think, really is that we can't ignore completely, as a lot of central banks have been doing in recent years, money supply statistics. And yes, there are different ways of measuring it, but surely with the millions of different economists they've got, we must be able to get a better overall idea. And what we can't do is ignore all these things. And that's why I think we're seeing a real question here is that if you carry on hiking interest rates and financial conditions tighten, we are at the risk of overdoing it. And surely we need to pause and have a proper look through all these things to make sure we don't make another mistake after ignoring inflation only just the last year.
If we do that, isn't there a danger that we let inflation get back out of control?
I think the bigger risk is ignoring what's coming in front of our face. Lots of different anecdotal indicators that we may be overdoing it. See how we've done. And I don't think there is a big impact in having to hike interest rates again if it's very, very clear that core inflation, which is very much a lagging index, like all employment data, and particularly things like shelter, which we look through, that they are telling us stuff where we can see the effect of higher interest rates starting to come through maybe, but we don't know the full impact of it. And I think we are better waiting, and then with a clearer, nothing's ever perfect, clearer economic overview. Then if interest rates need to go up again, so be it.
Yeah, but the markets are forward-looking, and then that gets confusing. Hey, Mike, we're looking ahead to CPI and talk about money supply and sort of the demand side, and you were talking about services. Where's the biggest risk tomorrow when we get those numbers?
Well, it's going to be in some of those services categories, at least as far as we know. Now, used car prices have gone up at the wholesale level. That hasn't translated into CPI yet, so we're waiting to see when that will hit. We should start to see a leveling out, if not a decline, in rents. But in terms of what's happening for airline fares, they've been going up, and for a number of other services, and the Fed's going to be looking at that to see the impact of perhaps wages and the lack of workers in some of those service categories on inflation.
Right. And is it going to be one more hike then done, or are we going to talk about June by tomorrow? All right, we're going to check it out. All right, Marcus and Mike, thanks a lot. Really appreciate it for joining us. So coming up, we're going to put our question of the day: is money too tight? To Jerry Fowler, UBS head of European equity strategy. That debate also revolving in, can you buy European equities right now, or is the U.S. actually safer? This is Bloomberg.